with us from Purdue University. He's going to present liquidity and risk in OTC markets, a theory of asset pricing. Okay, so Dejanir, you have 45 minutes. The stage is yours, please.
All right. Thank you very much for the invitation. It's a pleasure to be here. Are you guys hearing me well? Yes. Okay. So what's the motivation for this paper? Is at the end is the observation that liquidity basically tends to evaporate in bad times, exactly when we needed it the most. And the example that we have in mind here is during the recent COVID crisis, looking here in the US. So walking over top left, here you see that usually price of risky assets tend to decline in bad times, and interest rates go down as well. So exactly what we see here, short-term interest rate going down, sharp decline on the S&P 500. Also, the price of other risky assets suffer. So we see here on the right, the sharp increase in credit spreads, both for high yield companies as well as AAA. So this is kind of like the standard pattern that during bad times, interest rates go down, risk premium goes up as the price of risky assets tends to suffer. On the other hand, if you look to what happens to liquidity, we see that also liquidity tends to not suffer. So we see first a lot of portfolio reallocation happening during this period. So for instance, here we're looking at the corporate bond market. We look at the volume traded relative to the pre-crisis period. You see a sharp increase, like 40% in trading during this period. And at the same time, we see a substantial increase in transaction costs. So this is computed from data on transaction levels from Trace. And we see that the bid-ask spread increased by almost like tenfold during the periods of crisis. So we see at the same time, the sharp increase in transaction costs, increase in volume. We see also that investors shift their trades towards assets that trade at this lower pace. The literature has documented that. So you trade more expensive at this lower pace and trade more during these bad times.
And these trades are treasuries or stocks?
Corporate bonds. This is corporate bonds. So not looking at treasuries here. A lot of interesting things happen with treasuries during this period, but some people have worked on that already. So here I focus on corporate bonds for now. So therefore, thinking about liquidity and risk at the same time is crucial. And if you look at, for instance, at the Fed response to this event, they basically decided to buy some risky assets and trying to improve the liquidity conditions in the market. And basically what we need a framework to be able to assess these policies in a unified way. We can think about what interventions can do potentially to liquidity and risk, right? So the challenge here at the end is how to think about these two things at the same time. So when I first decided to think about this, that's the kind of thing that I imagined it was the kind of like easy intellectual arbitrage, right? So we have a lot of work on liquidity, thinking what the role, let's say, of search frictions affecting asset prices, right? On the other hand, we have our macro finance models that think about what happened with risk premium and interest rates during periods of crisis. So what we have to do is at the end is get one, put it with the other, put in the blender, we're done in a month. Well, that's a lot harder than it seems. So the reason is when you start diving in, looking at this liquidity problems. So first, the first generation of those models actually had no role for portfolio choice, and let alone like risk premium movements at all. Like you think about Gaddafi and Neil Peterson basically have like a 0-1 position on the asset. Literature basically relaxed that later on. You think about like the work by Lagos and Fochito, allowing for some richer portfolio choice. However, they made a crucial assumption. that allowed the problem to be tractable, which was that the investors have quasi-linear preferences. What the quasi-linear assumption does is, well, essentially eliminates the role of wealth. And then the key state variable in that class of problems is basically how many assets do you have right now that is going to determine how much you want to trade. Okay. But a lot of the things that we're worried about, that when you think about these periods of crisis, movements in risk premium and interest rates, come exactly from the curvature of utility and consumption. The fact that the investors have decreasing marginal utility of consumption that affects both the pricing risk in safe assets. In a sense, if you think about the consumption CCAPM, the risk aversion is key in there. The question then is, how can you unify these things? Is exactly what we do here. So we provide a unified framework to study liquidity and risk premium in a macro asset pricing model with a dealer sector. So essentially we have a competitive search or directed search plus wealth effects, meaning the wealth distribution is going to play a role. So what we're going to have is investors with CRA or Epstein's preferences in an economy, and now an economy with directed search. And then we're going to find a role for the joint distribution of wealth and portfolios. So this unifying some work in macro finance, where the wealth distribution is the key state variable determining the asset pricing implications, with the liquidity-oriented work, where the distribution of portfolios is a key determinant of liquidity conditions. In our saying, it's going to be the joint distribution of wealth and portfolio holdings that's going to be the key state variable. The challenge here, of course, is how to obtain tractability. And what we do, it will bring this technique that we call this as a state global perturbations. We use some approximation techniques. They're going to allow us to obtain some closed form expressions for asset prices, trading, and liquidity costs. So here, since I've been talking about this liquidity and risk to a Brazilian audience, especially because Março is in the audience, I can't resist to make one provocation, which is, I'm thinking this in context of the US and thinking in terms of like corporate bonds and things like that. And I think this is very important in this context. I think it is absolutely crucial and necessary to fully understand exchange rates in a place like Brazil, where liquidity frictions are first order, where you have violations of CIP and UAP like all over the place. So you have to think about liquidity and risk together at the same time. So I think like that type of idea is absolutely first order for you to think something like exchange rates in a place like Brazil. So just because I keep seeing it, Março picture here. What are the main lessons? So there's lessons about trading, asset prices, and liquidity. So basically we have trading. We're going to find that investors are going to, the trading behavior in the end is going to be determined by the distance of your actual portfolio today and the margin portfolio, which is going to act as a target. Of course, in frictionless models, these two things are always the same, right? So your portfolio is equal to what the market portfolio is. With frictions that you don't go there immediately, so it takes some time for you to go there, and you find that you choose larger and faster trades the further away you are from the target. Also, we find the distribution of portfolios in the economy going to affect the risk premium and interest rates. And interestingly, different features of this distribution have different impacts. In particular, when you're thinking about the risk premium, it is the asymmetry in portfolio holdings, how disproportionately sellers are away from the target relative to buyers, which is crucial to understand the impact of liquidity frictions on the risk premium. On the other hand, is the dispersion, on average, how far these investors are from the target, is what determines the behavior of the risk-free interest rate. We also characterize the behavior of liquidity as a model with endogenous transaction costs, and we find that the increase in portfolio dispersion leads to a higher volume, higher trading costs, and higher trading delays, in line with the evidence that we found for the COVID-19 crisis period. We calibrate all that period and find market reactions that quantitatively in line with what we expect there. So this paper connected to large literature both on search and microfinance, but for the sake of time, let me jump into the model. So this is a continuous time infinity horizon endowment economy. And agents have access to two assets: a riskless asset, trading in a frictionless market, and a risky asset that's a claim and aggregate endowment. Up until this point, this is essentially as a standard as we could make. And then the economy is going to be populated by investors and dealers. And there's a measure one of risk-averse investors that face frictions and trade risky assets, and a measure one of risk-neutral dealers who hold no inventory. It's kind of like a standard assumptions in search models. We're going to assume bilateral trading is going to be intermediated by capacity-constrained dealers.
So one question: when you're describing the role of risk premium and kind of how your results behave and what you expect, I was thinking that maybe it's not only aggregate risk that matters, or not only the measures of aggregate risk that we're used to thinking about, like beta, that matters, because they could interact in non-trivial ways with like liquidity and so on. But here, I think once you started showing the setup, there's going to be one risky asset, and when you're describing risk premium, it's all related to Z, right? This aggregate risk source. Okay.
Yes. So I think there's an interesting thought here. So one thing that this we're going to come back at the end perhaps is a bit related to what you mentioned. What exactly is explaining risk premium? Is just a beta or the quantity of risk? If you look at the market response during the COVID-19 crisis, one of the most remarkable things is the largest price responses were not from the riskier assets. So for instance, if you look at bonds, so the AAA bonds were disproportionately affected. And there's some recent work by Haddad, Moreira, and Muir, where they're basically arguing that this is a challenge for standard asset pricing models, because, well, usually would say yes, we have risk premium movements. It depends on different exposures of these guys to risk. What you're going to find here that's actually in the context of a single risk model, but the risk premium would depend not only on the risk exposure, but also on this portfolio distributions and some kind of measure of selling pressure that I'm going to try to make it more precise later on. And that can vary substantially across assets independently of your exposure to risk. So there's bilateral trading that intermediated by capacity constrained dealers. You just have continuous access to a competitive interdealer market. This kind of standard assumption in this class of models. The interdealer price, PT, is going to be endogenous. I'm going to solve for that in general equilibrium. I'm going to follow some diffusion process that we need to solve for. I'm going to assume a form of competitive search allowed last worship on the left. So I'm going to talk about that now. So what do I mean by competitive search or directed search? It means that it's not that you pick the phone and randomly call a number like in the standard random search model. You directly your search to different contracts or different submarkets. So dealers, they post committed contracts. They're characterized by two numbers: the number of shares sold to investors, and the fee that gives you the per unit intermediation fee paid by investors. So when investors buy the risky asset, they pay the interdealer price PT plus this intermediation fee. And when investors sell to dealers, they get the interdealer price minus this intermediation fee. Okay. So given this, dealers going to post a measured DT of this particular contract, and a mass of iota of investors going to submit orders to that particular contract. So then at the end, we're going to find that the relative importance of these two things is going to determine how fast these investors are going to be able to trade. In particular, we're going to have a matching function where the market tightness, the ratio of the mass of contracts posted by dealers over the mass of investors submitting orders to that particular contract, is going to determine the execution intensity. So here we're going to assume this is standard functional form for the matching function. So basically, investors are going to meet dealers at rate alpha theta. Okay, so the more dealers you have per unit investors, it's going to be easier for the investors to find a counterpart.
John, you may ask a question.
Sure.
I don't know this literature, but from what you said, the bid-ask spread is always 2 times phi.
Yes, and this guy is endogenous, right? So yes, exactly. Bid-ask spread is like the difference between this is like two times this guy, but it's endogenous. We have to solve for, right?
Okay.
So see, here's the problem of the dealer. Okay, so what's the dealer does? It chooses the mass of contracts that it wants to post. They're gonna depend on the intensity at which they meet investors. So investors meet dealers at rate alpha, and dealers meet investors rate alpha over theta. And after meeting this investor, the dealer makes profits given by the intermediation fee that they receive times the size of the contract. What matters is the absolute size because, well, you make profits if you're selling or if you're buying. It doesn't really matter. So, and importantly, these dealers are subject to a capacity constraint. So what do I mean by that? There are at a point in time, there's only so many contracts that these dealers can intermediate. And this capacity is given by this parameter D bar. This controls the maximum that these guys can intermediate in a given point in time. And this is going to be important. So this is like a linear problem for these dealers. So such that among the active contracts, the profitability is going to be equalized. They're going to be given by this Lagrange multiplier and the capacity constraint. This VD, this normalized multiplier, captures the profitability of the dealer. And this is going to be endogenous and going to fluctuate. This is in sharp contrast with what usually we assume in search models. What we assume in search models is not a capacity constraint. We assume there's free entry. So as long as there's some increase in profitability, potential increase in profitability, dealers are going to enter into the market and drive this thing constant, essentially. Essentially, you can think this, the standard search model is D bar as being endogenous and increasing as much as necessary to keep the profitability of the dealers constant. We think that this may be a reasonable assumption for the long run, but in the short run, during a period of a crisis, we don't see a lot of entry of dealers stepping in the market and stabilizing the spreads. So in contrast, we imagine if there's some capacity that the dealers can intermediate, a fixed spike your trades have to go through, and this is going to be important. So we think that this fixed capacity better captures what's going on in the short run. Actually, we generalize that in the paper. We show that when with some kind of convex cost of posting orders, basically everything that we say goes through. We have some potential response of the capacity as well, but as long as the cost is strictly convex, it's not linear, everything we say basically goes through, and the free entry essentially corresponds to this linear cost of posting orders. All right, so this is the dealer's problem. We're going to consider next the investor's problem. And as I promised, the investor's problem is going to look a lot like your standard problem, standard Merton problem. So we have CRA preferences, okay? And there's one difference with respect to the standard Merton problem. Usually what's your state variable is your wealth. Depends on how much wealth you start in the period. The shares, the SIs, the number of shares, is not really a state variable because we can jump to your desired portfolio immediately in a frictionless setting. Here, no, where you start, the period matters. So basically, SI determine your initial portfolio holdings, and this is going to play a role. So the law of motion of your wealth is relatively standard, except for the fact that you have some intermediation fee that have to pay if you trade, and there's also some periodic costs that here more for technical reasons that we can talk about that later. So here the law of motion of your portfolio shares depends on how much orders you post, and depends also on the realization of this post-selling intensity when you actually meet the dealers. So what's the motivation for trade here? So a lot of these search models have some exogenous motive for trade. Sometimes you like the asset, sometimes you dislike the asset. Not here. Actually, the only motivation for trade here is the fact that investors have different endowments of this risky asset. Some investors start with a lot and they want to sell. Some investors start with very little of the risky asset and they want to buy. Okay. So one feature of this is that eventually in the long run, they reach their desired portfolio and there's no more trade. We'll have an extension in the paper with heterogeneous risk aversion that actually have a role for frictions even in the long run. Then there's a market clearing condition that's relatively standard. So let me jump to the equilibrium characterization. So let's think about the first order condition for the dealer. So from the optimality condition for the dealer, we find that this proportional intermediation fee is essentially increasing in theta. So this alpha is like concave. So this is like an increasing in theta. So that means contracts that have a higher theta, that means they're faster for the investors to meet dealers, also have higher fees. So why is that? Well, higher fee contracts attract more dealers. This tend to increase the market tightness, making it easier for investors to find a counterpart. Basically, they can trade faster. Therefore, investors can choose. They can trade cheap contracts, which is lower, or can trade in expensive contracts, which are faster. You're in this speed and cost trade-off. So you pay some price for the immediacy. Here's the HTB for the investors problem, okay? And this is supposed to look like essentially like a hybrid between the HTB that you would get in a standard Merton problem and the HTB that you would get in a standard search problem. So this VX, VW things, if you remember your Merton problem, this should be very familiar. This is exactly what we have there. This here is the search part. With intensity alpha theta, you meet that counterpart and you trade. So essentially, you're going to switch states from S plus N. N is positive, you're buying, N is negative, you're selling. And your alpha here is going to go down by the intermediation fee, right? And basically, I use this formula right here to solve for the intermediation fee in terms of theta. So now you're effectively choosing theta. You can choose to trade faster, but then you're going to pay a higher fee, or you can choose to trade slower and you pay a lower fee. Okay, so here, for today, I'm going to make this simplifying assumption that we're going to assume that essentially there are two families that pool this order execution risk. What it's going to do is going to keep the amount of heterogeneity in the paper fixed. There's going to be essentially two types. One's going to be the seller, one's going to be the buyer. Okay, and all of the intuitions are going to come from here. In the paper, we relax that. We show that how to deal with the approximation methods that we're going to show you later. You can deal with even with the more general case, where there we have not only two types, we have an entire distribution depending on when exactly you trade. So what's the characterization for this problem? Well, the choice for consumption is pretty standard. But then a new thing appears, which is this omega, this object here. It's going to be key for us. This is what we call the marginal value rebalancing. That's the marginal utility of one extra unit of these risky assets in dollar terms. So I divided by the marginal utility of wealth. So it's useful to think about this object in the polar extremes of the Merton problem and the standard search model. In the Merton problem, S is not a relevant state variable. It doesn't really matter where you start. You can jump directly to your desired portfolio immediately. So Vs is equal to 0 and omega is equal to 0 in the standard Merton problem. What about the search model? Standard search models make a quasi-linear assumption. This quasi-linear assumption implies that wealth doesn't play a role. So the VW is essentially 1 and Vs is independent of W. Essentially, this depends only on your number of shares. Does not depend on your wealth. Okay, so this omega, this marginal value rebalancing, is going to determine how fast do you trade and how much do you trade. Theta, that controls this trading speed, which type of contract do you choose, is increasing in theta. So the higher this marginal value rebalancing, faster you want to trade. And this N is also increasing in omega. So the largest omega, the more this is positive. You're going to see basically you want to buy, right? That means that the value of increasing your asset is positive, so you want to buy. Okay. One important thing to think about is how often do we trade, right? Because we know from the literature with exogenous transaction costs, when you have different prices to buy and to sell, like in Constantinides 1986, there's an inaction region. Right. So basically, if the marginal benefit of trading is not large enough, basically it doesn't pay for the transaction cost, you choose not to trade. So the fact that this inaction region basically makes these problems a lot more complicated. Interestingly, this does not happen in this model with endogenous transaction costs, right? In this competitive search setting, because for small enough gains from trade, for small enough omega, investors choose a cheaper contract. You basically, yes, it may take longer for you to get executed, but you're going to end up paying a smaller fee. You can always choose such a contract. So for you, what you find, for you, it's always optimal to trade. So you find that despite of the presence of a bid-ask spread, you have continuous trading. So you're going to be able to actually characterize a bid-ask spread in a model of continuous trading that makes it a lot more attractive. So then, what is this omega? So this is the key object that you want to understand, right? So we have this characterization that shows that omega at the end is the present discounted value of deviations from a target relative to your actual portfolio share. Okay, so this is your asset position here. What's the target? Is exactly, literally, the Morton portfolio share. If you remember your like CCAPM, this is exactly what the portfolio would be. So under Merton, these two things would always be equal, and omega would be 0. With frictions, for instance, if this is below target on average, not only today, but on average in the future, so then you this omega tend to be positive, you want to buy. If it's above on average, so it's going to be negative, you want to sell. Notice that this object right here is endogenous and depends on the characteristics of the whole economy, while search models pretty much like postulate an omega function. So in a sense, you can think of this as an alternative market foundation for the asset Marshall valuation function in search models.
So what is the role of gamma hat, and what is gamma hat here?
Is the risk aversion, is the factor risk aversion. Yeah. At this point, we don't know if this is constant or not, so that's why I'm writing it this way. Yeah.
Okay.
So, so then this omega depends on how far you are from your target, and basically can show that the further you are from your target, you trade faster and you trade more, right? So if you're below the target, you buy. If you're above your target, you sell. Okay. So that's basically our first lesson. This omega also affects the liquidity variables, if you want. The intermediation fee is going to be proportional to omega. So the higher is omega, the further you are from your target, you're going to choose contracts with a higher intermediation fee. We're willing to pay more to trade when trade is more valuable to you. The distribution of these omegas in the population is going to determine the dealer's value, the profitability for the dealer. Like this is like range multiplier on that capacity constraint. So what this is saying is this is like a convex function of these omegas. So as it increases the dispersion in omegas, when buyers are really far away from their target and sellers are really far away from their targets, there are a lot of demand for trading. There's a lot of profit for the dealers. Their profitability increase. And then you can aggregate this and think about the implications for the risk premium in this economy. And what you find is you have like what I call a liquidity-adjusted consumption CAPM, where you have a consumption CAPM formula, where the risk premium depends on risk aversion and the covariance of consumption with the price. But you also have a new term that depends on this distribution of omegas that covary with consumption. So we're going to come back to this later. We're going to look at this from a different angle later on, but just to show you that in principle, this can get amplification or attenuation of the risk premium, depending on the sign of this whole object, and I'm going to spend a lot of time on this. So at the end, the aggregate state variables for this problem are going to be the endowment and the share of wealth for the first time and the share of assets for the first time. So in the end, you have to solve for functions of these states. Both have aggregate stuff depend only on aggregate state variables. Individual stuff depends on aggregate and individual state variables. So this is end up being like a big problem that's challenged to solve even numerically. So we're going to go a different route. So we're going to apply some perturbation techniques that are going to allow us to get some intuition and some sharp categorization of the equilibrium behavior in this economy. So we're going to do it in the following way. Consider a family of economies indexed by epsilon. Okay, so epsilon is going to be a small number in here. Epsilon is going to control the variance of the endowment, and also going to control the capacity constraint of the dealers. Okay, why do we need to scale both things? Well, because as it reduced epsilon, basically I reduced the amount of risk in this economy. I did reduce the demand for trading because, well, the risky asset and the riskless just become closer and closer together. So as to reduce the trading, I also need to, as to reduce the demand for trading, I also have to reduce the supply of liquidity in this economy. So otherwise, the supply of liquidity would eventually be abundant and there would be no liquidity frictions. So for liquidity frictions to be more relevant in the limit, you have to scale off.
Any reason for why it needs to be one unit of variance to 1 unit of the capacity constraint? Why is that square root for 1 or something?
Do the math and it works, but it's not super general, to be honest. I think in the version of the problem with more general cost, it may be a bit different. But you have what is general, we have to scale. That just so happens that it's one variance, one d-bar. So what do we do? So what we do is the following. So you consider a family of economies now, index parameterized by epsilon. Okay. So what we're going to do is we're going to look at the neighborhood of epsilon equals to 0. Epsilon equals to 0 is a very simple economy. I can characterize that by hand. Okay, basically nothing interesting happens there. But for a small but positive amount of risk, that's when the things happen. All right. And it turns out that if you know the benchmark, you can characterize what happens with your value function in the neighborhood of that. The logic, in a sense, is a bit similar to what you do from the perturbation of the SG, with a crucial and important difference that are going to make this very different, which is the following. In the standard ESG approach, we will do a small risk perturbation. What would you do? You linearize everything. Not only with respect to epsilon, but with respect to W, S, X, like everything. And so you will look for coefficients in front of this state variables. All right. And there's a problem because we know that what this does is Q risk premium. To get movements risk premium, we have to go like a third order approximations and so on. Here we're going to do something different. Instead of solving for coefficients, we're going to solve for potentially nonlinear functions. So this V until here, the potentially nonlinear function of the states. What it's going to do, it's going to allow us to get something that is, the economy doesn't need to be close to a steady state where the states are close to a particular point. We're going to look at this across the state space. It requires us to solve for these functions of the states. So it's going to get to us like some nonlinear effects. And in a sense, provide a global solution with respect to the state for epsilon sufficiently small, for the 4 economies where the amount of risk is relatively small. And importantly, it's going to allow for time-varying risk premium, interest rates, and liquidity up to first order, which is something that doesn't happen with standard methods. Okay. So actually, interest of time, let me show you some actual results out of this. So this is probably like the main thing that you want to take away. So using these perturbations, you can essentially characterize in closed form what is the demand for shares in this economy. Okay. So basically, the demand for shares depends on the risk premium relative to the portfolio share of one of the types here. So here's the demand. The demand is upward sloping here and the number of orders, because I'm plotting this as a function of the risk premium, not the price, right? Because the price is going to be downward slope demand as usual. Here, the supply, again, downward sloping because I'm plotting this as a function of the risk premium. Okay. And then now I can combine the two things and get to like an supply for shares and demand for shares, and then solve for the risk premium. Notice how different this is from the standard approach, but you don't get to see demand for shares, supply for shares, so on. What you get is something that is very familiar, the gamma sigma square. That's exactly the risk premium in the Lucas economy. Have no frictions at all. That's what we would get. In a term that depends on the distribution of portfolio shares in the economy. S over X is the portfolio share for one of the types. 1 minus S, 1 minus X is the portfolio share for the other type. And we're going to see that this can create amplification, dampening, or neither. So let's consider first a case where there's no amplification. So this is the simple case where everyone started their desired portfolio. I invest 100% of my wealth in the risky asset. You invest 100% of your wealth in the risky asset. There's no trade. Basically, supply and demand meet at 0. And here is looking at the state space. This is the point where the portfolio share is equal to 1. So basically, this 45-degree line here. I'm think about this point where the wealth in the asset is equal to 0. This makes sense. There's no trade, nothing happens, no amplification. Now think about the case where there is trade. So for instance, my portfolio share is 0.5 and Marcelo's portfolio share is 1.5. Marcelo wants to sell to me, I want to buy, right? Well, I really like this asset because I'm far away, I want to buy it. I want to buy this thing to create some buying pressure, push the price up and push the risk premium down. On the other hand, Marcelo really dislikes this asset because he has a lot of it. He wants to sell. This creates some selling pressure to push the price down, the risk premium up. If we're equally distant from our target, 1.5, 0.5, the buying and selling pressure is exactly equal, and they balance out exactly so that there's no amplification. So even though there's trade, the risk premium in this economy coincides with the risk premium in the Lucas economy. There's essentially no amplification in this economy. Consider now the case where we're disproportionately farther away from our target. Now, Marcelo has a portfolio share of 2.5, while I have 0.5. He's much farther away from the target than I am. So he really dislikes this asset. He creates a lot of selling pressure, a lot more than I create of buying pressure. So at the end of the day, this tends to push the price down, amplifies the risk premium, and magnifies the magnitude of the risk premium in this economy. The risk premium in this economy now depends not only on risk and risk aversion, but it depends also on the distribution of portfolios shares in this economy, and in particular, how symmetrically it is. This asymmetry can come as how there's an equal amount of buyers and sellers, but they hold disproportional portfolios, or maybe they're equally distant, but there's a disproportional amount of sellers. Now, not only me buying, Marcelo and Felipe, now they're selling. So a disproportional amount of sellers, this creates the same kind of asymmetry. This creates the same kind of amplification. Okay. So the first lesson here for asset pricing is the symmetry in portfolio shares creates amplification. When you look at the interest rates, you get this expression, which also looks familiar. Except for this term in brackets, this is exactly the expression for the interest rate in the Lucas economy. In the Lucas economy, this term in brackets will be equal to 1. Here, this is like a convex function of the distribution of portfolio shares, and increasing the dispersion of these portfolio shares, then to decline the interest rates, the further away these guys are from their portfolios, basically tend to push interest rates down. Okay. So that's the lesson number 2, the role of portfolio symmetry and dispersion. Asymmetry creates amplification of risk premium, and dispersion tend to depress interest rates. Okay, basically it's tend to amplify the pressurized savings motive, pushing interest rate down.
Dejanir, could you provide the intuition why the interest rate is pushed down?
Yeah, so basically what happens is the further you are from your target, your asset gets like misallocated. You get like more afraid of getting undesirable price movements that may affect your wealth, and you get more cautious. Is if you're able to do the right thing, the thing that you want to do, you're more confident and you're less afraid. So then you have less precautionary motive. But if you may get stuck in a bad position, then we'll say, now things can go wrong. Like suppose that you're stuck in a very high, leverage, right? So you tend to get a bit more cautious, and this then amplifies their precautionary motive, pushing interest rates down. We have also implications for market liquidity, and here we'll look at different measures of market liquidity. So focus on the orange line here. Okay, so the way to think about this plot is this point right here, like 0.5, is the point where there's investors reach their desired portfolio and there's no further trade. Okay, so the further you are from your target, as it's saying, as move this way, let's say, there's more trade, the volume increases, the profitability of the dealers increase as well, the bid-ask spreads tends to increase, and the trading delays also increase. Notice that this function is highly nonlinear. So even though I'm doing the first order approximation in absolute, I'm still able to capture the nonlinear dynamics in the state space. So the third lesson then is that dispersion raises volume, costs, and trading delays. So why does the trading delays go up? Remember that the further you are from your target, it usually would want to trade faster. But with a limited capacity, there's no way that you can actually trade more and trade faster. There's only so much trade that dealers can intermediate. So as investors want to trade more, they tend to increase the transaction cost so much that they actually switch to trades that are more slower to try to economize on this transaction cost. So this tends to increase trading delays. So what I said up until now is that if dispersion increases, interest rates go down, trading volume goes up, transaction costs go up. If asymmetry goes up, with the risk premium increases. This generates the patterns that we saw at the beginning, but I haven't told you up until now why you would expect the asymmetry and dispersion behave in the way that they should. So look at this plot right here. So basically the one on the right is telling that this is the exposure of dispersion asymmetry to risk in a sense. So after a negative shock, basically what happens is, so this thing is like a negative number for most of this, basically all the state space. So that means that a negative shock tends to increase dispersion and increase the asymmetry endogenously. Here you see the role of wealth effects. If the wealth didn't matter, after a big negative shock, yeah, you lost some wealth because the economy went down, but the number of shares didn't change. Nothing would happen if I had like a standard search model here, just by saying that there's the value of the asset went down, right? Is the fact that the value of the asset goes down affects your wealth and affects your portfolio share. It depends on the wealth, right? Then you get this effect. So endogenously, the model generates counter-cyclical dispersion and asymmetry. Bad times, asymmetry tends to endogenously increase, dispersion tends to endogenously increase. Basically, this leading to increase in risk premium, depressing interest rates, increasing trading volume, transaction costs, and trading delays. All these patterns are, like I mentioned, consistent to what we saw at the beginning and consistent with the patterns during the COVID-19 crisis. This is consistent, for instance, with the evidence in Adamo and Muir that I mentioned before. One of my co-authors have also some work studying the behavior of corporate bond markets during the COVID crisis. For instance, they document the increase in trading delays as investors switch it to trades that take a longer time to get executed. Okay, and the final part of the paper, what we do is try to get like some mileage on the quantitative front to see whether or not this can generate numbers that make sense. One issue that we have to deal with is the fact that in the previous version of the model, in the long run, essentially the liquidity frictions essentially disappear because eventually you reach your desired target and there's no further trade. The way to deal with that is we introduce Epstein's preferences and difference in risk aversion, assuming that investors have a common EIS. By having different risk aversion, investors have different target ratios. So one investor may want to invest more than 100% in the risky asset, and one invest less than 100%. Even if they reach their desired portfolio, now a negative shock is going to move them away, and you have to rebalance back, right? So even if you eventually reach your desired portfolio, shocks move you away, such that the liquidity frictions will matter even in the long run. Okay. So here's the calibration. It is relatively standard. Most of this, the trading part at the end, we get a lot of this from frictions on the corporate bond market, and then we were able to match standard asset pricing moments. Also, we match some liquidity based measures. And we find that actually the frictions do a lot of the heavy lifting, right? So basically, without these frictions, we don't find a lot. So having frictions really helps. And again, the endogenous countercyclicality is basically key, right? So basically, what happens in bad times is endogenous countercyclical kind of acts a bit like risk aversion increases in bad times. So what we do then is look at the dynamic impact of a large negative shock. So we're thinking about mechanisms just like what happened with COVID, right? So consider the large negative shock. So what's going to happen is the leverage investors are going to lose wealth, and they're going to need to rebalance. So basically, think about if you start leverage, if you start with like 1.5, if you have a negative shock, your leverage naturally increases, right? Because you lose more wealth than the assets lose value. That's what leverage does. So that means that you have to trade back, So this creates a lot of demand for portfolio rebalancing, reallocation, just like we saw at the beginning, this increase in trading volume, right? So, and this higher demand for trading in a setting where there's a fixed pipe, that there's a limit on how much trade can get executed in a given point in time, is going to lead to impacts in the transaction costs and the speed at which these investors can trade, and ultimately on asset prices, on the risk premium and the interest rate. So what are we going to do? We're going to compute the response of the economy. Start at the stochastic steady state, a large negative shock is essentially going to increase the bid-ask spread by as much as we saw in the data, which is much like a 10-fold increase in bid-ask spreads. And this large shock will induce some asset pricing and trade dynamics. And that's pretty much what we saw. So basically, you see sharp increase in risk premium, like 25% increase relative to the pre-shock level. The sharp decline in interest rates. Interest rates were like basically 1% at the beginning. They go to, the change is -1, so basically interest rates go basically to 0 and then recover. The bid-ask spreads increase tenfold, and we generate like a 20% increase in volume. This is kind of half what we observe in the data. It's like 40. So we're in the ballpark, a bit short of what we saw in the data. All right, to conclude, so basically we provide an asset pricing model with liquidity frictions and wealth effects. We have essentially a competitive search model in a standard asset pricing environment, and use perturbation techniques to obtain some closed form solutions that allow us to clearly characterize how aggregate trading, asset prices, and liquidity behave in this economy. And we particularly highlight the importance of trading flows, the idea of your asset positions matter, right? In models where the share of initial shares of the asset are not a state variable, basically volume doesn't play a role. I can switch the asset around, trade more or less, and still nothing will be different. Here, no, here the trading matters, right? So we found that interest rates and risk premium respond to flows. There are implications for volume, bid-ask spreads, and trading delays. And the model is generally consistent with this dash for cash, or this kind of movements that we saw in March 2020. We think that this is can work as a baseline from some future work that looks at the implications of liquidity and risk. You can look, for instance, at dealers' inventory behavior, something that's particularly important after the Fed's intervention, and also look at the impact of policy in a setting like this. All right, thanks.
Thank you, Dejanir. Impressive as always. Congratulations. Well, we have time for some questions. So guys, please.
So I got I got curious about one thing, but I might have misunderstood that. So basically, you're assuming that whenever a trade occurs in a given contract, the fee that's charged on both sides is the same. And I was wondering because the reason, or it's not. Okay.
No, because there's multiple contracts that can happen. So you can imagine that the buyer is in one. It's just like this is a bit of a normalization, because the contract is there are multiple contracts. The contract that the buyer is choosing is different than the contract that the seller is choosing, because then there's one contract with N is positive and one contract with N is negative. So what you're going to observe at the end is if there's one fee for the buyer and there's one fee for the seller. They don't need to be the same.
Okay.
Right? The way that I'm defining here, I'm saying that it's just for a particular contract. If that contract is a buying contract, then that's what happens. If that's a selling contract, that's what happens. But the contracts themselves can be different.
Yeah.
So Jenny, let me ask a question, maybe completely off, but if you change the market structure to a centralized book where everybody had access to, you would solve all the problems?
So depends a little bit on how we do it. So if you think of this formulation at the end, it's not that different to a limit order book, where you have some open orders there that are not still filled, and you choose which order to submit, and then that thing can get filled or not. So I feel that to get like a limit order book here would be very similar. Is you imagine that you limit order book, you may not trade right away, right? Depending on the order that you put. If you assume, of course, that this trading is centralized and it happens instantaneously, then all of this goes away. So then you can think of this as what we're doing is essentially showing you the departure from that, right? So in a world where bid-ask spreads matter, where they move around and so on. I say that to say that I think this kind of frictions may matter for even for trading stocks. The magnitude may be different across markets. In some markets, you could expect like this to be more relevant for things like corporate bonds or foreign exchange.
Yeah, the reason for my question is because Daryl Duffy has been pushing a lot to change the structure of the Treasury market.
Oh, right? Yes. Mm-hmm. But I think there is on the centralized clearing, right? So if I'm thinking about the same, if I remember what like Duffy was saying, what I do remember, it was pushing for centralized clearing, which is a different issue than this. It's also a kind of liquidity issue, but like not quite the same as the one I'm attacking here.
Marcelo?
Can I ask not a simple question, but again, in a completely different setup. You can think about, people who are optimistic and people who are pessimistic. Mm-hmm. And it seems to me that in your model, though everybody's rational and everything, you can get exactly the same flavor you get with optimistic and pessimists. Is that so, or am I missing something? I'm jumping too quickly to conclusions.
It depends on what exactly do we have in mind, right? So
just the flavor, like that. If you have optimistic and pessimistic people, markets can be reflecting much more pessimistic or the optimistic, and this is going to drive the.
I see the connection now. I see, like, your point is you could imagine like it's at the end. The market may be reflecting, like, depending on how you do, like a Miller type of story, like, oh, with optimists and pessimists, like the market will reflect the beliefs of the pessimists or things like that. You can think of this is a bit like a continuous version of this kind of things, right? So where the weights that you give to optimists and pessimists, buyers and sellers, here basically depends. And at the end of the day, it's kind of related to like this asymmetry. At the end is what controls who is the relevant one in some sense. So I can definitely see the connection now that you mentioned. Yeah, there's a lot of the same flavor.
And if I am to carry out an empirical exercise, like reduced form, using time series or whatever, you have those nice impulse response there because you have your own model and you know exactly how to identify the shock. Mm-hmm. How would you identify shocks now, flow shocks using data? What kind of implications your model have?
So let me tell you what you want to do, what you don't want to do. At the end of the day, this is a model about demand fluctuations in trade. So what the shock is doing at the end is increasing the demand for trading because investors need to reallocate. And this creates a particular correlation between trading volume and transaction costs. This correlation could completely flip if I put like supply shocks and not instead of fluctuation of the demand, fluctuations like the D bar, for instance, then the unconditional correlation is not what you want to do. What you want to do to test this model is you have some shock that tends to induce more reallocation, more trading, okay, for a given capacity of the dealers. And what you expect is like the higher demand for trading is lead to more trading, like more volume, but also higher transaction costs, higher trading delays, particular effects on prices. So the more that you see this reallocation happening exactly are the markets where you should see more price dislocation. So that's the kind of thing you could see. The hard part is how to get the shock on portfolio reallocation. My impression can be done is like probably some of this stories on I don't know, there's a change in the index and these guys have to rebalance it and they can adjust. So you can think like of things like that, or I have like I thought a little bit about like using some kind of heteroistic stochasticity type of identification, maybe to try to get some of these things. So periods of more volatility, you may want to trade more or less, things like that. But that's kind of what you want. Would you want something that shifts trade, and then you want to see the liquidity and transaction cost patterns, and you want to see difference in asset prices, the cross section in line with this. If you want the COVID is almost like it's a laboratory for that. Like it's a bit of this thing is so big that we're hoping that this is kind of isolating a big shock to the demand and generating the pricing patterns that we want. So, but of course, we'd love to have a more systematic way of testing this.
COVID has like many shocks within it.
That's true.
Right? You
That's
have
definitely
a
true.
huge uncertainty shock. You have a pretty big composition shock as well, because now you have, at least in Brazil, right, the number of individual investors increased so quickly, you know, in March, April, and probably May.
Yeah.
So it's
here I think the second thing is a bit less of concern.
Sure.
The uncertainty is for sure first order. Like, and the thing with the nice thing about the COVID setting is a lot of the pricing patterns kind of goes against the uncertainty story, right? So if you go to the Moreira Muir paper, what they show is, look, a lot of the price movements, like the big proportional changes, are exactly the places with less exposure to this increase in uncertainty. So your first candidate, which be like, okay, uncertainty just went to the roof, and this is explaining these patterns, doesn't seem to explain. And they really like have a hard time. They look say a lot of our models like gonna fail to generate like a pattern like that. And I think our model can deliver exactly that, because at the end, what this is showing is it's not so much about movements in this guy here, but a movement in this guy. That's why you're seeing this pattern happening where it is, where it's exactly where you see a lot of this dislocations and reallocations happening. This is exactly where you're seeing most of the price movements, even though those guys are kind of the opposite of what you'd expect in terms of the uncertainty story.
Cheers.
Bom, alguém mais? Bom, muito obrigado, Dejanir, pela disposição em contribuir para a Sociedade Brasileira de Finanças. Artigo com um problema interessante, tratado com muito rigor. Obrigado.
Muito obrigado,
pessoal,
prazer é meu.
obrigado.